Hey everybody, so this video is a recording of an office hour that I held today on November 18th, 2022. Answered a couple of questions about options, so calls and puts. Also, we went over a couple of questions on CAPM. So I hope you enjoy it, and if you have any questions, leave them in the comments. Okay, don't forget to hit that subscribe button, and yeah, let's go ahead and watch the video.
Hey, John, good you?
Good. Okay, so let's get into it. I guess Carmela, you can start. What's up?
I have two questions, so I DM them to you.
Yes. If you guys have specific questions you want me to read, just send them and I'll put them on the screen.
John, do you have the textbook?
I do.
You do? Okay. For me, it's question. I want to go over question 40 of the options chapter.
Hold on. Chapter 12. Question 40. What page is that on? Hold on. Okay, let me find it.
It's the one with the big table.
Oh, yeah. I think Maria was asking that same question. Like the challenging one?
Yeah.
Yeah. Oh, I'm just gonna find it. Just to make sure we're looking at the same thing. Long put 95 cents, negative 5 cents, that one?
Yeah.
Hold on. Yeah, I'll put that up on the screen. This one, right?
Exactly.
Okay. And Carmela, did you send yours? Oh, okay.
Yeah, I sent them, but let me know if you can open them because last time it didn't work. I don't know why.
You're taking it from your phone, and sometimes the iPhone's format. No, I can open these, no problem.
Okay, there's two questions. It's just three pictures because it was like split up differently. But
Okay. Yeah, he'll just tell me how to organize it if I get it wrong. So there's this, and then there's this.
John, I also would like you to give an explanation on the whole long and short put. I find it like very confusing. I can't wrap my head around it.
Long and short put.
I'll like I have it'll come up in the question, but I don't understand. Hold on. Well, if Rob wants to go first, he can go first. Honestly, it's okay with me.
Hold on. I'm just getting your stuff here.
Like we have a call option and a put option, right? So then
Yeah.
in both there can be a long payoff and a short payoff.
That's right.
How do we know which one we're dealing with to solve the question?
I'm gonna tell you. Like if you buy an option, that's the long position. But if you sell an option, that's the short position. Like in this question, basically.
But here they're doing both.
Yeah. So you have both.
That's why I'm confused. I don't know.
You have both. You have two. It's like having two different stocks in your portfolio. Look. So for this question, the way I would do it is you have one call option. So you have a long call. Okay. And you have two put options that you sold. So you have a short put and you have another short put. So you have three options in your portfolio. It's like you bought three different. It's not like it's fine. You can have one call and one put in your portfolio, and there's nothing wrong with that. So for the long call, you're going to use the long payoff method, and for the short put, you'll use the short payoff method. So they're saying that the price of the stock at expiration is 52.12, right? So that's what we.
Wait, John, can I just ask a question again? Like the way I see it, there's two sections, like call and put, and then in each section there's two formulas. So in all, it's four formulas, right?
Yeah.
That's where I get confused on which four to use when. Like that's what I don't understand.
Well, look at for the call, okay? This is a long call, so you're going to use what you have in your notes specifically on that.
So basically, you're finding the IV, the intrinsic value.
Yeah. So,
But
but
how did you know it's a long call? Like, sorry, I know these questions are really like simple.
Buy means long.
buy means
Okay,
long.
but buy means long
Yeah,
and
Should mean sell.
that's it.
oh.
The word to
Okay,
buy,
so if it were to say sell one call option, then it would be short.
you got it. That's why I put short for these two, because you sold two puts.
Oh, okay, thanks.
That might be the so let's solve this question, but that sounds like it was the main issue. So then you know what to use. So like long call, right? Look at your notes. How do you find the payoff for a long call? Right, you take the
S minus X.
okay, so S is 52.12. X is the strike price of 50. So your payoff here is 212.
Okay,
Okay. Then for the short put, how do you find the payoff for a short put?
it's still S minus X.
Okay, so now S in this case is 52.12, but the strike is 55. So what's the math on this? Negative 2.88. And it
Yeah,
says,
that's what I got.
and he says you take the lesser of this or zero. So we're going to take this because it's less than zero, right?
Mm-hmm.
And
Negative 2.88 means it's in the money, right?
it's in the money, but because you're in the short position, you're the one losing the money.
Losing it. Okay.
Now for the premiums, the long position is to pays the premium because they buy it. So the premium would be minus $2 for the buy, and then what about the shorts?
Plus $2.
Plus $3 because it's $1.50 two times.
Oh,
So plus $1. Now, if you put this all together, you would get the answer. So 2.12 minus 2.88 minus 2.88 plus 1. The answer was probably somewhere in the realm of 2.64.
yeah, but negative.
That's it.
Like I mean, I got the answer, but that's not what I did. I just played with the numbers.
But it's because you knew the answer, so that doesn't count. Right? You knew what the answer
Yeah.
was. You were able to play with them until you got there. But do you understand now? I think all you were missing, honestly, was the long short. Buy is long, short is sell.
It buys long and short is sell no matter if you're in call or put.
Exactly. It doesn't matter even if it's a stock.
Right?
Like the word too long is to buy something. You could long a stock, you could long an option, you could long a house, right? You're buying something.
Okay. Yeah, that definitely clarifies a lot.
Since it's on the same topic, let's look at Rob's question here. Okay, Rob, was it something specific that threw you off or the whole table threw you off?
It's after D, I had no idea. Like I kind of know what's going on with the first four, but I don't. I was just like
Okay.
the only thing that I understand is like the value of the option today and the profit, like they balance each other out. So like I would assume that it's 90, the value of the underlying asset, right?
Yeah, because I mean you're losing five. So this is a long put. Your profit is 5 cents, and the premium was 5 cents. So yeah, you're not making money, you're not losing money. So the value of the underlying asset 90 makes sense because you're on the money. So you're not in the money. I guess if you had to choose, you're out of the money.
Out.
Payoff would be zero.
So it would be at the money.
Yeah, they didn't give you an option for that though. So at or on the money. The best answer would be that you're at the money. Yeah.
Okay.
Because you understand, because think about what a profit is. Profit is when you combine payoff with the premiums, right? So like for a long position, it's the payoff minus the premium. So since the profit was negative 0.5 and the premium was 5 cents, it means your payoff must have been zero.
Okay. So if it was a short, it would be payoff plus premium.
It would be payoff exactly plus because they collect the premiums
Plus premium.
for sure.
And is this the case for like
Any
All?
option. Any option.
Okay. And how would we know like if it's like a short call or put and like from G to N?
Shit. Okay. You have to deconstruct it, I guess. So profit -2. I've never seen this question, so we're gonna work it out together. Profit is -2. The value of the underlying asset is 135. Sorry. Is wait, you're doing G. Okay, -2. The value is 105. So that would be like S, I guess. The premium is 2. The intrinsic value is 0. And you lost money. You lost the premium. So you must have been long.
Okay.
You see that?
Okay.
Because
Yeah.
loss is negative, you paid the premium. Okay. And the strike price is 35 and the stock price is 105 and it's not in the money. So which option is not in the money here? A put option would not be in the money in this case, right? Because the strike price is less than the value of the asset.
It's not on the money because it's 0?
It's not in the money because I mean, we have to try and figure out if it's a put or a call, right? So when I look at this, it's not in the money because this is 0.
Yeah.
So if this were a call option, it would be way in the money because a strike price of 35 and an asset price of 105, it would be like $70 in the money. So this can't be a call option. It's got to be a put option. Remember that a call option is in the money, right? A call option is in the money when the stock price exceeds the strike price. And a put option is in the money when the stock price is less than the strike price. So here it's not in the money. The stock price exceeds the strike price. So it's got to be a put.
Stock price exceeds the strike price.
Look, we're going to zoom into these two numbers here, okay? Because you understand this well, so just think about it. If this were a call option and the strike price was 35, okay? And the strike price was 35, and today the stock price was 105, would it be in the money?
Assuming that it was a put or a call.
A call.
If it was a call, that means it would be in the money because S105 is bigger than 35, which is X.
But I'm telling you that it's not in the money, which implies it must be a
Put.
put.
But the reason why you say it's not in the money is because of the 0 though, right?
0 intrinsic value. That's what tells you it's not in the money. This is how I knew it wasn't in the money. This one is in the money, you see?
Because it's either 0 or it's either the greater of 0 or X minus S.
Right. Now this one is the same prices, $70 in the money. This has to be a call option.
Okay.
You see? It's a tough question. It's not for nothing that they called it. I think they wrote that it was challenging, right? But it's really testing on all the little details.
That's what I'm trying to, that's exactly why I wanted to go over it, because I feel like if I would understand this, I would understand
Everything.
much better.
Yeah. Now look, $68. You're $70 in the money, but the premium is 2. Now, did this person pay? Would you be paying the premium here or would you be collecting the premium?
You're collecting it.
Why? Your payoff was 70, but you ended up walking away with $68. Means you paid the premium. You collected the $70 payoff, but you had to pay a premium of $2.
This is so confusing.
Look, if the option made $70 as the, oops, if the option made $70, but your profit was 68, what does that tell me? It tells me that we had to pay $2 to buy the option.
And that's what, and is that what the 2 is?
That's the
That's
2.
what the
2 is
that's
the
the
value
2.
of the option. That's the premium.
Okay.
This tells me that this is a long call because they paid the premium. Let that sink in for a sec. Right? When we pay the premium, you're long.
The intrinsic value is 70.
Yeah.
But you paid 2. So it means you lost $2, so your profit is actually 68.
Very good. That's why it's a long. You understand? That's how I knew it was long. Okay.
Okay.
Let's do I just since we're on it. Okay. Okay, so what do we know about I? We know it's a call option. We know the strike is 85. We know the value today is 100. Okay. What is the intrinsic value of the option?
We know it's a call, but we
Yeah.
don't know if it's a short or long.
Intrinsic value is, it doesn't matter, right? The intrinsic value is independent of who the person is. They didn't ask you. Well, I guess that's not clear what they said here. Payoff, intrinsic value. What is the intrinsic value?
It's basically the value of the option. Like not really the value, but like it's like what your payoff would be.
Very good. So in this case, what is the intrinsic value? It's a call option. Is it in the money?
If it's a call and the S is greater than the X, yeah, it is.
It's in the money by how much?
By 15.
By $15. Okay. So it's $15 in the money. You make a profit of $2.
So that means the premium is 17?
The premium is, if anything, the premium is 13.
13.
Okay, so the premium is 13, and you are in the which position?
You're longing.
Now you're starting to see it. Because you pay the premium.
Okay. Okay. So then the second one, it's a put, but the S is greater than the X. So the option, the value would be 0. And the value would be 0. The payoff is $2.
Profit is $2.
The profit was $2. So I would say this is a short put.
And how much was the premium?
The premium was $2.
Very good. Because 0 payoff plus $2. When you collect the premiums, you were in the short position.
Okay. Okay. Okay.
It's look, you all know every single one of these elements. It's just you've never seen it like this, and it is a challenging question. I honestly don't expect this question on the exam, obviously, but if you could solve this question, if you could really explain it back to yourself, like, okay, if I pay the premium, that's long. If I receive the premium, that's short. That takes care of the first column. Then, understanding the put and the call and how you can figure that out from the strike and the stock. I mean, you have to know that, right? You have to know based on these two, if it's in the money, if it's out of the money. And that's how you solve this question. You would do the rest and fill up all the blanks.
I don't know why, but the H is like throwing me off though. Like I don't know why. I would have thought it was a short call.
Why?
Just because I saw the payoff was a positive, but now I have to realize that
How could look, if you're in the short position, are you collecting the payoff or are you the one who's losing that money?
you're losing that money if you're in the short position.
So how would you make $68?
That's true, because that's not the premium.
Oh, this is the profit.
That's the profit.
Now you see it.
That's the profit. Okay. Okay. It's getting there. It's getting there.
Carmela, your other question, are these the same question?
Yeah, but wait, can you go back to the first question that we did?
This one?
Yeah, can you re-explain the premium parts? Because I'm not sure if I understand that part.
When you buy something, you have to pay for it, right? So you pay the $2, but when you sell something, you're the one collecting. So we collected the $1.50 2 times. So I paid $2, but I collected 2 premiums of $1.50.
Oh, okay.
You see it?
Yeah.
So in total, your net premium was $1.
Okay.
Okay, so here, is this in the right order?
Yeah. What did I do for this one?
Stock is return 12 beta 1.2. Oh, I remember this question. People couldn't understand why it was overvalued or undervalued. So let me.
Yeah, that's what didn't make sense to me. Like I was stuck between.
They have the same beta, right? Which means they have the same risk. So in theory, right, they should have the same expected return according to CAPM, right? Because CAPM says that 2 stocks with the same beta should have the same expected return, but they don't. They have the same amount of risk, but A has a better expected return. So what we know is, let's go through them. Portfolio AB beta is less than 1.2. Well, no, right? It would be exactly 1.2. because you're putting some money in A, some money in B, and they have the same beta. So the beta would be equal to 1.2.
But I knew that A, D, and E were all wrong, but I just I got stuck between B and C.
So if A is correctly valued, that means that this is the correct number, right? The 12, which means this would be lower than what it should be, and B would be overpriced. The answer is B here. If this is correctly priced, that means this is K. And here for B, expected return is less than K, because they should have the same required rate of return if they have the same risk. Same risk, same K, same required rate of return.
Like when I get confused, am I supposed to like see beta as K?
No.
That's what confuses
that
me. Like,
yesterday
how do you?
in a chat, right?
Yeah, like
Beta is not.
I don't know. I always get stuck because I in the table that like you gave us.
Beta.
I don't know. Is there a way to put
we use beta to find K.
Yeah, I see that in the formula that you gave us, but I'm just like when it comes down to these questions, I'm so used to looking at the table to compare to figure out if it's overvalued or undervalued, and when beta is not in there, it throws me off. Like I don't know where to look.
You don't use beta to decide if it's overpriced or underpriced. We use beta to find K, and you use K to figure out if it's overpriced or underpriced. That's what I told you yesterday. So look, here, beta is 1.2. So I'm going to, so for, let's say stock B, I'm going to use this fact to know that the K here should be 12%. And then I'm going to compare this to the expected return and say, oh, it's overpriced because the expected return is lower. I'm not comparing beta to anything, but I'm using beta to determine my required rate of return.
But it's that simple that if the beta is 1.2, you can assume that the K is 12%.
Well, it's because they said that A was correctly valued. So we knew that this was K.
So this is a theory question.
Yeah. There's no math in this question.
But can you repeat what you just said, John?
If,
we knew that
A is correctly valued, that means K equals expected return. So they're saying that A is correctly valued, which means this expected return is also the required return. Okay, let's start with that. Okay, you see that? From them saying that A is correctly valued, I look at A. Okay, correctly valued means K and ER are the same. So I have ER, so I have K. Is that okay?
Yeah, but then that doesn't mean that.
No.
Okay,
but then B has a beta of 1.2 also, which means B has the same K.
Okay.
And the expected return is 10. So then you're like, well, 10 is less than 12. Expected return is less than required return. So B must be overvalued. You have to connect. You can't go from the beginning of the question to the end. You have to connect all these dots. Say, okay, because they said this, then I know this, and because of this, I know this, then I can get my answer.
So technically, stock A is like correctly valued because of the K equals the expected return.
Yeah.
So that's why C is no wait. Okay, now that part is in both questions. So it's just stock B.
Yeah.
But standard deviation is completely irrelevant here.
Completely irrelevant for with CAPM and stocks, we use beta. We don't use the standard deviation.
Correlation has nothing to do with anything either right here.
No, correlation between them is 0. That's just, yeah, I don't see any use for that, honestly. Maybe maybe if there was a different question with different options, then maybe this question was written with like 10 different questions attached to it. Maybe that's why they have some stuff in there you don't need. But for this particular question, I don't see any use for correlation. I don't see any use for standard deviation. Carmela, are you okay?
Yeah, I'm just processing things. I went back to the other question that I asked you about the other day to see if it made more sense now.
Does it?
I'm still processing it.
All right, while you process that, Rob, you have anything you want to talk about?
Yeah, I'm trying to like solve some of these questions. Like I don't know, I'm trying to do it like mentally. I don't know if I should be writing it down, but I'm trying to see if I could do it mentally.
Like
But like
this
for
one.
example, K,
Hmm.
like letter K. So
Yeah.
I know it's a call,
Okay.
and the S is 100, and the X is 85. So the intrinsic value is 15.
Mm.
But the minus 10 is really throwing me off. I
Hmm.
don't know, like I don't know exactly what, like if the intrinsic value is minus 15, but your profit is negative 10,
Yeah.
does that mean like
Come on, man, you got it.
is it a short call?
Very good.
But I don't know why. Like I just had a feeling
Okay.
that it is, but I don't know why.
Okay. The intrinsic value is $15, right? But you
Yeah.
lost $10.
Okay.
Premium was $5, which means you lost 15 because you were in the short position, but you collected 5 on the premium, so you only lost 10.
Oh, okay.
Okay. Don't forget about this column over here.
Oh my God. Okay. Okay, so basically the intrinsic value plus the value of the option equals the profit. Okay.
Well, the payoff, right? So the intrinsic value is the intrinsic value. Now, the payoff could be positive if you're in the long position and negative if you're in the short position. You understand? So
Yeah.
the option was $15 in the money, but you were short. That's why you lost money.
Okay, let's try. Oh, 80. It's a short. No, I don't wait. I don't know yet. The X is 85. The S is 100, but it's a put.
Mm.
So that means it's X minus S,
Mm.
which means it's either the greater of 0 or X minus S. The greater of 0 or X minus S. So it's 0.
Good. So it's out of the money.
It's out of the money. It's 0. And that means that the value of the option is $2.
Mm-hmm. And you were short or long?
Short,
Why?
because you lost the $2.
And the short position pays the premium.
No, they get the premium
So that means you must have been in the long position because you lost
because you
$2.
because you lost the $2. Okay, this is gonna take some time.
Just go slow because you had it perfectly. And then when you rushed into the final answer, you got that answer wrong. Everything else you said was perfect. Okay. The long position pays the premium. So think about it. If the option is not in the money, right? There's no intrinsic value, but you lost $2. So you must have paid the $2 upfront.
Okay, so if you're not in the money, that means in the long position, all you lose is the premium.
That's it. The most you can lose as a long position is the premium, right?
The premium.
Yeah.
Okay.
You get it?
Yeah, M is a short call.
Yeah, try it.
110, but we don't know the value of the underlying asset, but we do know that the intrinsic value is 0.
Uh-huh.
So is the value of the value of the $0, $2. That means you're in okay, so you're short, you're getting the premium.
Yeah, we knew that. But
So it's out of the money.
out of the money.
It's out of the money. But the value of the underlying asset, we don't even know what the value of the option is also.
What we do, right? That you can figure out.
Two. It's 2.
Two.
Right? It's
Yeah.
2. Okay. And that means that if it's a short call, that means that it's the lesser of 0 or X, or right? Is it that lesser of 0 or S minus X? Is it that?
Yeah. So we know that that's 0, right? So what does that tell me about S?
Wait, is it lesser of S minus X or X minus S?
Short call is the lesser of X minus S.
X minus S. Okay. So if it's the lesser of X minus S and it's 0, So that means, and the X is 110. That means it's 112.
No, if it was 112, it would be in the money. Don't even think about it that way. You already know it's not in the money, right? So you know that this option, that the stock price can't exceed 110, right? If it exceeded 110, it would be in the money. It's a call option.
Oh, okay, I completely disregarded that.
The only thing you know for sure is that this is less than or equal to 110. It could be 109, it could be 108, it could be 105, it could be 25. It's not in the money. We have no idea what it is. You see that?
Yeah, because it's X minus, it's 0. That means it had to have been
It's out of the
higher
money.
than exactly.
Yeah.
So the value is,
You can't know the value. You just know that it's not in the money. So the
oh,
only
we don't know.
no, you just know that it's not bigger than 110.
Okay, so that would be, we don't actually put a value for it in this case.
I would write it like this: less than or equal to 110.
How come we can't figure it out, the value of the underlying asset?
Because there's nothing, because you never figure out the value of the underlying asset. You're always told what it is. The only thing I know for sure, like if it was 105, if it was 110 or 30, it would be the same thing. It would be out of the money, and everything else would be the same. So you can't know exactly what it is when it's out of the money. You just know that it's not in the money.
Okay, so the only reason why the first 4 were because they were in the money.
No, like even this one, technically, you don't actually know that it's 90. You just know that it's not, it's a long put. So the value can't be less than 90. So this has got to be greater than or equal to 90. So we don't know, we don't know if it's actually at the money. We just know that it's not in the money.
So given that they don't give us the value of the underlying asset, we just have to assume it's greater than this amount or less than this amount.
Well, it's not that we assume. We knew it was not in the money. So then this is a function of that.
But there's no way to guarantee exactly what the value
No,
is.
not if it's out of the money, because it could be anything. 110, 120, 160, 1,000 is all out of the money. So it could be any one of those numbers, right? If it's in the money, then you could figure it out using the intrinsic value. Like, let's say B, right? B, the premium was $2, but you lost $1. So the payoff must have been $1, right? Because 1 minus 2 would be -1. So if the intrinsic value is $1 and the strike was 90, this price must have been 91. It was $1 in the money. So when you're in the money, you could figure out exactly by how much.
Wait, 1 minus 2?
Yep. Why? I'm in a long position and I'm paying a $2 premium. And my profit at the end was -1, which means my payoff must have been +1 because I paid a $2 premium and ended up with a loss of -1.
So the value was $1, but you paid $2.
The payoff was $1, but you paid $2.
And that's why your loss is -1.
That's where your loss is -1. Now, if the payoff was $1, it means you were $1 in the money. So I know the price had to be 91.
Because also we know that it's a long call.
We know it's a long call. We know the strike price was 90.
And the intrinsic value is 1, so that means the value must be at 91. Okay. Okay, yeah. This is gonna no.
It's a good question to spend some time with, just talking to yourself, like explaining it back to yourself for sure.
Like I feel like if I get this question done and I'm able to actually understand it, it'll do wonders.
Yeah, you understand the whole chapter if you understand this question.
Yeah.
Yeah.
100%.
John, I have 2 other questions.
Okay. Did you send them?
Well, one of them I
see.
one of them I sent, yeah, but the other one is just a security with a beta of 0, we said, doesn't mean that it's risk-free.
No.
Right?
No.
So,
it's not
but does it mean that it's
the expected return is the risk-free rate?
But does it imply that the variability is fully diversifiable?
No. That means the same thing, I think.
That
The
means
only thing it implies, the only
these fancy words.
yeah, the only thing that it implies is that the expected return would be equal to the risk-free rate.
Okay, so this whole fancy sentence it means that
The
risk-free.
variability, meaning the risk, can be fully diversified.
It's fully diversifiable.
That basic. Uh, wait, no, that kind of does make sense actually, because if the beta is 0, there's no market risk, which means there's no systematic risk, which means there's only unsystematic risk. And unsystematic risk is diversifiable. Now, that statement is correct, actually. Wow, yeah, it's a good one. If beta equals
Or
0,
is it?
the variable.
It's marked as not correct though.
Can you send me the question? I want to see the wording. Because just like that,
Yeah,
it
hold on.
sounds like there's no market risk, so there's no systematic risk. There's only unsystematic risk. And unsystematic risk is diversifiable. Maybe the word fully is what's you're sending it?
Yeah.
Okay.
Well, we could do this one first, and if you want.
Uh,
This one first. Like I got the answer right here, but I literally I mean, it was the luck of the draw because I don't think I understand the background.
you hold 4 stocks in your portfolio. The portfolio beta is 1.038. Stock A is 20%. Has a beta 0.72. You sell all of A and put in a risk-free asset. Yeah, we did this in class, no? So if you have your portfolio beta like this and you sell 20% of it, what would I do? I would subtract 20% and
Like, can I tell you what I did?
okay.
I just want to know if it's right, if my reasoning was right. So I put 1.038 equals 0.72 times 0.2 plus 0 times 0.8. And then I brought the 0.72 times 0.2 to the other side and I subtracted it and then I got 0.89.
Yeah, so you ended up doing this.
Yeah, basically.
Yeah, that's totally fine.
Okay. So I got it right for the right reasons, and I
Yeah,
just wanted to make
perfect.
sure because I didn't.
Perfect.
So is this it? The answer?
That's the answer. Look back at when we did chapter 9, we did a question just like this. We did a few actually.
Yeah. So, but the risk-free asset and invest the proceeds in the risk-free asset.
You
But
basically took that money and put it into something that had a beta of 0, so it changes nothing.
that's it. Okay. All right.
Right. So whoever was writing this exam just assumed that 0 because of risk-free and just completely missed the question. Carmel, did you send that other one? I didn't see anything come in.
I'm working on it. Sorry.
Rob, any news on that question?
No.
Okay.
He didn't even he clearly didn't even
I think
tell anybody.
I think they'll end up giving it because if the other prof is acknowledging that the answer is 6.2, then I mean, come on. I think
Like it doesn't. I just don't get. I just don't get how he didn't see it like you though. That's what doesn't make sense to me. Why didn't he recognize it? Why didn't he realize like you did? He just kept fighting and fighting. Like no, you're doing something wrong. You're doing this and that.
it's hard to admit.
That's what like he didn't even at first he didn't even want to realize that there was a possibility that it was an answer.
Yeah.
Rob,
No,
did you end up doing well though on the exam at least? Or not really.
Well, I got a 59.
I mean, you're top of the class.
But when they dropped the 30 out of the overall marks from 35 to 31, I ended up getting a 71.
yeah,
Oh
but
wait, so there's adjusted marks posted, so my mark is not actually my mark.
Well, I
Yeah.
don't know. I'm really assuming that they adjusted the marks because
they bumped everybody up 12%.
yeah, exactly. So I assumed that I got 59% originally.
Okay, so you're taking it out of what he posted.
Yeah, honestly, I'm not 71. Honestly, in my mind, the 71
No, but
is one of my greatest.
you earned the 78. And you know what I mean? Like at the end of the day, if you finish this class with like an A minus and you could have got an A, it's gonna piss you off, right? So you got that question right.
If I get an A minus in this class, I'm gonna
Okay.
applaud myself.
You understand what I mean? Like you end up with a B plus, but you could have got an A minus. You earned the grade.
Yeah, then
You got it wrong. You got it right. So I think you should get the mark. Anyways, this is the question, right? Security with a beta of 0 implies that all of the variability in the security's return is fully diversifiable. Oh, okay, there's more to it. By any investor holding a well-diversified portfolio in the U.S. market. The most
like, is that even relevant? Most efficient market in the world? Is that like, what even is that? Like, do I just ignore that?
No, yeah, I think that's what makes it wrong. Because like technically, if the sentence, maybe the word fully diversifiable. I don't like the word fully, because you can't fully diversify even unsystematic. You can reduce it a lot, but you can't get rid of it.
But fully diversifiable would mean that there's no risk, right?
Only if you diversified like fully. Right?
Wait, is it unsystematic risk or systematic risk that's diversifiable?
Unsystematic.
Unsystematic risk is diversifiable.
Yeah, but
Like,
not fully. It's not. I don't like the word fully here that much, because you can have every stock in your portfolio, you still have a little bit, tiny bit of unsystematic risk. So maybe that's why it's wrong. And then if you look at the other two, the SML slope is a market risk premium. That's true. And the CML slope is a Sharpe ratio. That's true.
Yeah.
No, I knew that 2 and 3 were right, but I got stuck between C and E because I didn't know.
You have the actual answer. They said the actual answer was C. Like, do you have the actual solution to this? Like, it should say it somewhere.
Yeah, the first one's wrong.
Yeah, the first one's wrong, but is C correct?
Mm-hmm. That's right.
Carmela, is this like where do you get these questions?
Somebody said
I have a friend that gave it to
okay,
me.
so this is not from like the finals that they posted on Moodle.
No. This is during
No.
tell it's online.
Okay, yeah.
I don't like the word fully here. That's probably why A is that, you can, if you have
But
no.
can you dumb down what the first statement is saying? Because I don't even think I understand it. Like, chances are I wouldn't have picked it just because I don't understand.
Beta of 0 means there's no systematic risk. So there's only unsystematic risk. Unsystematic risk is diversifiable. True. Is it fully diversifiable? No, you're still going to have some risk. Like, you're still, even if it's a little bit, you still have some risk. And then investors holding a well-diversified portfolio in the US market, the most efficient in the world, like, I feel like that's just trying to make statement 1 look more true. Like, for somebody who doesn't know, like, oh, well, I guess that makes sense, and they just choose it, right? But I don't like the word fully here. That anything beyond that, I don't care. I don't like that it said fully diversifiable. You can't get rid of.
You don't like that because.
Well, because even if you have all your money invested in a bunch of different stocks, you still have risk. You still have some, even if it's a little bit, you still technically have some. Fully diversifiable means you're eliminating all your risk. No, right? This is saying all variability, all risk is diversifiable, is avoidable. No, you still have, you're gonna have a little bit of risk. You can't get rid of all your risk.
But that just goes back to the fact that you said that a beta 0 implies that doesn't imply that it's risk-free.
Right. That's why I don't like 1 as
just knowing that, I could say that it's wrong.
I mean, no, I mean, because if it would have said implies that all of the variability in the security is, if they would have.
Like, what if it just said diversifiable and not fully?
If they would remove that
would have been.
Then I would like it. I think I would like it as an answer. Because unsystematic risk is diversifiable. Yeah. This goes back to like the end of chapter 8, right? The systematic versus unsystematic risk, and how unsystematic is diversifiable, meaning you can reduce your unsystematic risk.
John, like the questions that we would do in for CAPM in the session where you take out of one beta and put it into another. There was not a single question, not one in the book on that.
Say again, where you take
Like when you take the beta, when you take it from like one portfolio and then you put in the beta of another portfolio, like what we did before, like with the risk free.
this one? No,
No, down, the one that you just passed. That
this
one. There's not a single question in the book that does this.
but there's on every exam. They expect that if they tell you the basic formula and show you a basic example, then you can figure out the more difficult ones.
Because they don't technically, like in the chapter, they don't go over this at all. They don't do one example. They don't do anything.
No, they go over portfolio beta, but they don't go over
No,
where you remove a stock.
exactly. That's what
No, but technically this is just portfolio beta,
okay.
you know?
John, can you go back to the question where it was overvalued and undervalued? I just want to make sure I wrote.
This one? Sure. Yeah, this was
Yeah.
basically
After John, can you go up to the table for the options question so I could take a screenshot, please?
Sure. The one we did, the one you asked, right? Like this one here.
Yeah, exactly that.
I'm gonna take this recording, by the way, and put it on my YouTube channel for you if you want to come back and watch it again. Just because like
Okay.
very technical. So if you missed anything, you can go back and watch it again. I'll post it like, by the end of the day.
It was actually really helpful. Thank you very much. I'm gonna try doing this. I'm gonna try doing this now, like by myself.
Yeah.
But now I actually understand the gist. Like, okay, I'm gonna do it. So
Look,
just
it's gonna help you understand the ins and outs of it. So it's really good. It's really good to go back and just erase everything and do line by line, explain it. And don't just say, okay, I remember it was 0. Why is it 0? If you could explain it to yourself, or
why
better,
is it zero?
if you could find another student in class and explain it to them, then you know you got it.
The thing that I just have to remember is that if it's out of the money and we don't know the value of the underlying asset, we don't know exactly what the value could be.
Yeah,
It could only be greater or less.
Right, exactly. But that honestly, that part is the least significant part of all this, I think. Okay.
Okay.
Yeah. Okay.
All right, John. Thank you so much for your time. I really appreciate it.
Yeah, thanks, John.
Don't forget, guys, we don't have class on Monday, but we do have class next Monday. So
Oh, I thought it was the opposite.
no, because the 21st I was supposed to be away, but so the 21st we don't have class. The 28th we have class. So you
Okay.
have an extra week. So it's fine though. You should spend all this week on chapter 9, 12, and 13, and then we'll meet in like 10 days to do the last chapter.
But how many do I have left? We just have 20 and
That's our last class. 14, we have chapter 14 is the big subject for that day, and then chapter 20 we're going to do as well. 20 is really small though.
Hopefully
Okay.
I won't have to go to my actual class so I can actually be there this time.
Perfect.
I'm gonna try.
I hope you're good. All right.
All right.
Okay. Thanks, John. Have a good weekend.
Too.
Have a good one. Ciao.